हेलो दोस्तों, बिजनेस माइंड में आपका स्वागत है। और अभी हम कर रहे हैं चैप्टर 2 जो है इकोनॉमिक्स की 12th क्लास का। ठीक है, फर्स्ट चैप्टर कर लिया है, नहीं देखा तो प्लेलिस्ट बना रखी है, उसमें जाकर आप देख सकते हैं। नेशनल इनकम अकाउंट इस चैप्टर का नाम है, नेशनल इनकम अकाउंटिंग। तो इन दिस चैप्टर we will introduce the fundamental functioning of a simple economy. In section 2, we section 2.1 we describe some primary ideas we shall work with. In section 2.2, we describe how we can view the aggregate income of the entire economy going through the sectors of the economy in a circular way. The same section also deals with the three ways to calculate the national income, namely product method, expenditure method, and income method. The last section 2.3 describes the various categories of national income. It also defines different price indices like GDP defaulter, consumer price index, wholesale price indices, and discuss the problems associated with taking GDP of a country as an indicator of the aggregate welfare of the people of the country. Some basic concepts of macroeconomics. One of the pioneers of the subject we call in economics today, Adam Smith, named his most influential work An Inquiry into the Nature and Cause of the Wealth of Nations. What generates the economic wealth of a nation? What makes countries rich or poor? These are some of the central questions of economics. It is not that countries which are endowed with a bounty of natural wealth, minerals, or forests, or the most fertile lands are naturally the richest countries. In fact, the resource rich Africa and Latin America have some of the poorest countries in the world, whereas many prosperous countries have scarcely any natural wealth. There was a time when possession of natural resources was the most important consideration, but even then the resource had to be transformed through a production process. The economic wealth or well-being of a country thus does not necessarily depend on the mere possession of resources. The point is how these resources are used in generating a flow of production and how, as a consequence, income and wealth are generated from that process. Let us now dwell upon this flow of production. How does this flow of production arise? People combine their energies with natural and man-made environment within a certain social and technological structure to generate a flow of production. In our modern economic setting, this flow of productions arise out of a production of commodities, goods and services by millions of enterprises, large and small. These enterprises range from giant corporations employing a large number of people to single entrepreneur enterprises. But what happens to these commodities after being produced? Each producer of commodities intends to sell her output, so from the smallest items like pins or buttons to the largest ones like aeroplanes, automobiles, giant machinery, or any saleable service like that of the doctor, the lawyer, or the financial consultant. The goods and services produced are to be sold to the consumers. The consumer may in turn be an individual or an enterprise, and the good or service purchased by that entity might be for final use or for use in further production. When it is used in further production, it often loses its characteristic as that specific good and is transformed through a productive process into another good. Thus, a farmer producing cotton sells it to a spinning mill where the raw cotton undergoes transformation to yarn. The yarn is in turn sold to a textile mill where, through the productive process, it is transformed into cloth. The cloth is in turn transformed through another productive process into an article of clothing which is then ready to be sold finally to the consumers for final use. Such an item that is meant for final use and will not pass through any more stages of production or transformations is called final good. Why do we why do we call this a final good? Because once it has been sold, it passes out of the active economic flow. It will not undergo any further transformation at the hands of any producer. It may, however, undergo transformation by the action of the ultimate purchaser. In fact, many such final goods are transformed during their consumption. Thus, the tea leaves purchased by the consumer are not consumed in that form. They are used to make drinkable tea, which is consumed. Similarly, most of the items that enter our kitchen are transformed through the process of cooking. But cooking at home is not an economic activity. Even though the product involved undergoes transformation, home cooked food is not sold to the market. However, if the same cooking or tea brewing was done in a restaurant where the cooked product would be sold to customers, then the same items such as tea leaves would cease to be final goods and would be counted as inputs to which economic value addition can take place. Thus, it is not in the nature of the good, but in the economic nature of its use that a good becomes a final good. Of the final goods, we can distinguish between consumption goods and capital goods. Goods like food and clothing, and services like recreation that are consumed when purchased by their ultimate consumers are called consumption goods or consumer goods. This also includes services which are consumed, but for convenience we may refer to them as consumer goods. Then these are other goods that are of durable character which are used in the production process. These are tools, implements, and machines. While they make production of other commodities feasible, they themselves don't get transformed in the production process. They are also final goods, yet they are not final goods to be ultimately consumed. Unlike the final goods that we have considered above, they are the crucial backbone of any production process. In aiding and enabling the production to take place. These goods form a part of capital, one of the crucial factors of production in which a productive enterprise has invested, and they continue to enable the production process to go on for continuous cycles of production. These are capital goods and they gradually undergo wear and tear, and thus are repaired or gradually replaced over time. The stock of capital that an economy process is thus preserved, maintained, and renewed partially or wholly over time, and this is of some importance in the discussion that will follow. We may note here that some commodities like television sets, automobiles, or home computers, although they are for ultimate consumption, have one characteristic in common with capital goods: they are also durable. This is, they are not extinguished by immediate or even short period consumption. They have a relatively long life as compared to articles such as food or even clothing. They also undergo wear and tear with gradual use and often need repairs and replacements of parts, that is, like machines, they also need to be preserved, maintained, and renewed. That is why we call these goods consumer durables. Thus, if we consider all the final goods and services produced in an economy in a given period of time, they are either in the form of consumption goods, both durable and non-durable, or capital goods. As final goods, they do not undergo any further transformation in the economic process. Of the total production taking place in the economy, a large number of products don't end up in final consumption and are not capital goods either. Such goods may be used by other producers as material inputs. Examples are steel sheets used for making automobiles and copper used for making utensils. These are intermediate goods, mostly used as raw material or input for production of other commodities. These are not final goods. Now, to have a comprehensive idea of the total flow of production in the economy, we need to have quantitative measure of the aggregate level of final goods produced in the economy. However, in order to get a quantitative assessment, a measure of the total final goods and services produced in the economy, it is obvious that we need a common measuring rod. We cannot add meters of cloth produced to tons of rice or number of automobiles or machines. Our common measuring rod is money. Since each of these commodities is produced for sale, the sum total of monetary value of these diverse commodities gives us a measure of final output. But why are we to measure final goods only? Surely intermediate goods are crucial inputs to any production process, and a significant part of our manpower and capital stock are engaged in production of these goods. However, since we are dealing with value of output, we should realize that the value of final goods already includes the value of the intermediate goods that have entered into their production as inputs. Counting them separately will lead to the error of double counting, whereas considering intermediate goods may give a fuller description of total economic activity. Counting them will highly exaggerate the final value of our economic activity. At this stage, it is important to introduce the concept of stocks and flows. Often we hear statements like the average salary of someone is rupees 10,000 or the output of the steel industry is so many tons or so many rupees in value. But these are incomplete statements because it is not clear whether the income which is being referred to is yearly or monthly or daily income, and surely that makes a huge difference. Sometimes, when the context is familiar, we assume that the time period is known and therefore do not mention it. But inherent all such statements is a definite period of time, otherwise, such statements are meaningless. Thus, income or output or profits are concepts that make sense only when a time period is specified. These are called flows because they occur in period of time. Therefore, we need to delineate a time period to get a quantitative measure of these. Since a lot of accounting is done annually in an economy, many of these are expressed annually, like annual profits or production. Flows are defined over a period of time. In contrast, capital goods or consumer durables once produced do not wear out or get consumed in a delineated time period. Chitrit.
Chitrit. Delineated?
Chitrit time period. In fact, capital goods continue to serve use through different cycles of production. The buildings or machines in a factory are there irrespective of a specific time period. There can be addition to or deduction from these if a new machine is added or machine falls in disuse and is not replaced. These are called stocks. Stocks are defined at a particular point of time. However, we can measure a change in a stock over a specific period of time, like how many machines were added this year. Such changes in stocks are thus flows, which can be measured over specific time periods. A particular machine can be part of the capital stock for many years unless it wears out, but that machine can be part of the flow of new machines added to the capital stock only for a single year when it was initially installed. To further understand the difference between stock variables and flow variables, let us take the following example. Suppose a tank is being filled with water coming from a tap. The amount of water which is flowing into the tank from the tap per minute is a flow. But how much water there is in the tank at particular point of a time is a stock concept. To come back to our discussion on the measure of final output, that part of our final output that comprises of capital goods constitutes gross investment of an economy. These may be machines, tools, and implements, buildings, office space, storehouses, or infrastructure like roads, bridges, airport, or jetties. But all the capital goods produced in a year do not constitute an addition to the capital stock already existing. A significant part of current output of capital goods goes in maintaining or replacing part of the existing stock of capital goods. This is because the already existing capital stock suffers wear and tear and needs maintenance and replacement. A part of the capital goods produced this year goes for replacement of existing capital goods and is not an addition to the stock of capital goods already existing, and its value needs to be subtraced from gross investment for arriving at the measure for net investment. This deletion, which is made from the value of gross investment in order to accommodate accommodate regular wear and tear of capital, is called depreciation. So new addition to capital stock in an economy is measured by net investment or new capital formation, which is expressed as net investment equals to gross investment minus depreciation. ये हो जाएगा एक formula. Let us examine this concept called depreciation a little more in detail. Let us consider a new machine that a firm invests in. This machine may be in service for the next 20 years, after which it falls into disrepair and needs to be replaced. We can now imagine as if the machine is being gradually used up in each year's production process, and each year 1/20th of its original value is getting depreciated. So instead of considering a bulk investment for replacement after 20 years, we consider an annual depreciation cost every year. This is the usual sense in which the term depreciation is used, and inherent in its conception is the expected life of a particular capital goods, like 20 years in our example of the machine. Depreciation is thus an annual allowance for wear and tear of a capital good. In other words, it is the cost of the good divided by number of years of its useful life. Notice here that depreciation is an accounting concept. No real expenditure may have actually been incurred each year, yet depreciation is annually accounted for. In an economy with thousands of enterprises with widely varying periods of life of their equipment in any particular year, some enterprises are actually making the bulk replacement spending. Thus, we can realistically assume that there will be a steady follow of actual replacement spending, which will more or less match the amount of annual depreciation being accounted for it that economy. Now, if we go back to our discussion of total final output produced in an economy, we see that there is output of consumer goods and services and output of capital goods. The consumer goods sustain the consumption of the entire population of the economy. Purchase of consumer goods depends on the capacity of the people to spend on these goods, which in turn depends on their income. The other part of the final goods, the capital goods, are purchased by business enterprises. They are used either for maintenance of the capital stock because there are wear and tear of it, or they are used for addition to their capital stock in a specific time period, say in a year. The total production of final goods can thus be either in the form of consumption or investment. This implies that there is a trade-off. If an economy produces more of consumer goods, it is producing less of capital goods, and vice versa. It is generally observed that more sophisticated and heavy capital goods raise the ability of a labor to produce goods. The traditional weaver would take months to weave a sari, but with modern machinery, thousands of pieces of clothing are produced in a day. Decades were taken to construct the great historical monuments like the pyramids or the Taj Mahal, but with modern construction machinery, one can build a rapper in few years. More production of newer varieties of capital goods, therefore, would help in the greater production of consumer goods. But are not we contradicting ourselves? Earlier, we have seen how of the total output of final goods of an economy. If a large share goes for production of capital goods, a smaller share is available for production of consumer goods, and now we are saving more capital goods would mean more consumer goods. There is no contradiction here. However, what is important here is the element of time at a particular period given a level of total output of the economy. It is true if more capital goods are produced, less of consumer goods would be produced. But production of more capital goods would mean that in future the laborers would have more capital equipments to work with. We have seen that this leads to a higher capacity of the economy to produce with the same number of laborers. Thus, total input itself would be higher compared the case when less capital goods were produced. If total output is higher, the amount of consumer goods that can be produced would surely be higher. Thus, the economy cycle not only rolls on. Higher production of capital goods enable the economy to expand. It is possible to find another view of the circular flow in the discussion we have made so far. Since we are dealing with all goods and services that are produced for the market, the crucial factor enabling such sale is demand for such products backed by purchasing power. One must have the necessary ability to purchase commodities, otherwise one's need for commodities does not get recognized by the market. We have already discussed above that one's ability to buy commodities comes from the income one earns, as laborers earning wages, or as entrepreneur earning profits, or as landlord earning rents, or as owner of capital earning interest. In short, the income that people earn as owners of factors of production are used by them to meet their demand for goods and services. So we can see a circular flow here which is facilitated through the market. Simply put, the firm's demand for factors of production to run the production process creates payments to the public. In turn, the public's demand for goods and services creates payments to the firms and enables the sale of the products they produce. So the social act of consumption and production are intricately linked, and in fact there is a circular question here questions here. The process of production in an economy generates factor payments for those involved in production and generate goods and services as the outcome of the production process. The income so generated create the capacity to purchase the final consumption goods and thus the enable their sale by the business enterprises, the basic object of their production. The capital goods which are also generated into in the production process also enable their producers to earn income, wages, profits, etc. In a similar manner, the capital goods add to or maintain the capital stock of an economy and thus make production of other commodity possible. अब ये करेंगे कल.